Now, also one big and very bold call today. Now is the time to buy into equities. So reckon those at Goldman Sachs, who say that stocks are set for a steady upward move over the next few years. The chief global equity strategist, Peter Oppenheimer, says this: it's time to say a long goodbye, farewell to bonds and embrace the long goodbye as opposed to sell for equities. He says the prospects for returns in stocks versus bonds are as good as they have been in a generation. His words, not mine. Investors like Goldman are favouring stocks over bonds after Treasury yields tumbled last year. And joining us to discuss all this is Paul Donovan, Deputy Head of Global Economics at UBS Investment Bank, travelling the region. More than a minute. Paul, you are busy. 8 countries, I believe, you've been doing in 2 weeks. You must be very jet-lagged, but you're here on caffeine, I guess. A good old cup of coffee.
Yep.
Let's talk about, before we get to Ben Bernanke's comments, this Goldman Sachs call, quite a bold one, clearly, the best in a generation. Do you think that Goldman Sachs is more or less the horse is bolted?
Well, you know, it's always nice to see UBS's competitors catching up to the UBS way of thinking. We actually came out...
He says modestly.
He says modestly. We came out over a week ago saying, actually, this is, we believe, the start of a secular bear market for bonds. Now, it's not 1994. We're not going to see a sudden dramatic sell-off in bonds, but we think we're now moving into the bear phase of the bond market. Yields today are a long, long way below fundamental fair value. I'm not saying they get back to fundamental fair value. I think there are a lot of distortions which will remain in the markets, but that bear phase has come in. And in that environment, yes, equities should outperform bonds. I'm not sure it's going to be a smooth process. I think we're talking about a re-rating rather than earnings growth driving the process. And if that's what you're getting, then it could be a quite volatile process of equity improvement, but certainly outperformance.
To understand the bond direction is quite complicated. Can you explain what you think is driving this bond situation? And also, are you surprised by it?
Well, what we've got at the moment is basically the entire world is using the gilt market as a model now. The gilt market, for certainly my entire career, has been distorted by regulation, by government controls over the pension industry and things like that. And we're starting to see this come in more and more in other markets. You've got captive investors who've been distorting yields for a long, long time. Now, if we look at Europe, if we look at the States, that's keeping yields fairly low, but these distortions will ebb a little bit over time. The investors who have a choice are not being attracted by current yields. They're starting to move out. So yields creep up a bit, I think. But as I said, I mean, it's not going to be a collapse in bonds. It's a slow process.
Let's look at the economy. Ben Bernanke comments last night, echoing Christine Lagarde's on Tuesday night about how the oil price is very much an alarming concern for him. Now it's at 107 or so, thereabouts, a barrel. Ben Bernanke and Lagarde both saying it in the space of 2 days. This is now the alarm, isn't it? It's not so much the euro, which is being contained for now, it's the oil price.
Well, oil is an issue for the United States. It's not necessarily so big an issue globally.
It could be inflation there.
Well, it depends, you see, because a rise in the oil price is not that big a part of inflation. It's about 5%. The biggest impact on inflation is labour costs. And in most countries, at least in the OECD, labour costs are very contained.
And food costs.
Food costs are also generally still fairly benign. Now, I mean, food costs are also largely labour. You go out and buy a pint of milk, you're actually really going out and buying labour costs. You're not really buying milk at all. If we look at what fuel does, when fuel prices go up, that simply transfers money basically from America to Saudi Arabia. So the question is, what does Saudi Arabia do with its money? And of course, they're spending more of their money today than they've done in the past. So that does provide some support to the economy. One of the big problems we've got, though, with America is, of course, they don't tax fuel very heavily. So rising oil prices are very visible. And the other problem is really the great tragedy of modern civilization. We don't have enough economists in the world. What we have are an excess...
How can you honestly say that? There are too many economists.
No, sadly, we don't have enough. We have a surplus of irrational consumers. And consumers, when they think about inflation, they don't think about inflation like I do, a carefully weighted basket of 1,000 and a half different items. When a consumer thinks about inflation, they think about what they buy on a regular basis. And Americans, of course, filling up their sports utility vehicles every second day with gasoline, they notice when the price goes up, and that does affect their sentiment. So that's why I think Bernanke is concerned.
So if you go to university, forget medicine, forget law, do economy.
It would make the world a better place.
I'm sure it would. I disagree wholeheartedly. No, I don't really. Let's quickly discuss, if I can, the US the growth rate is below trend.
Yes.
The figures have been strong recently, but that's your call. That's your big call, isn't it?
It's going to stay below trend, I think, for some time because we're deleveraging. Now, it's not an absolute rule, but if you're going to get trend growth, you need the private sector debt-to-GDP ratio to be stable, and it's not. The debt-GDP ratio is coming down at the moment, so you're likely to come out with a below-trend growth rate this year, next year.
Paul Donovan, please don't go away, because after the break we're going to have more from Paul Donovan, particularly his Asian trip and also his thoughts on Greece. Welcome back, and we are back with Paul Donovan, Deputy Head of Global Economics at UBS Investment Bank. I must ask you, Paul, you are on this incredibly intense trip for 2 weeks across Asia. Just give us a few of the cities you're going to.
Where are we going? Seoul, Shenzhen, Hong Kong, obviously, Singapore, Brunei, Taipei, Australia, yes, Melbourne, Tokyo a couple of weeks ago. So yes, quite a few.
Tell me then the feeling. What are you're giving presentations?
Yes.
What is the feeling about? Let's go first of all to Euroland.
Yeah.
You've got research there. Greece. The IMF literally has a fantastic prediction that Greece will achieve 116.5% debt of GDP. You are saying the chances of Greece meeting its targets were as good as they were before the politics started. It's not going to meet its targets. It will default.
It will. I mean, this is nonsense. You know, the idea that by some miracle Greece is going to start getting growth. I mean, Greece is about to enter its 5th year of negative GDP growth this year. I mean, that is completely unprecedented. It's a dire situation. And I think it's going to be very, very difficult to turn that around. The debt-GDP ratio will be above 116.5%. I think we can pretty much say that's certain by 2020. And even if by some miracle it is 116.5%, I really don't think the private sector is going to turn around and say, well, in that case, we'll start funding your bond market. So I think we've got to restructure. The problem has always been so much of the debt is held in public sector hands now, the Troika, the IMF. That debt was not included in the last restructuring. It needs to be. Otherwise, Greece is unsustainable.
When you do this 2-week tour, how many questions do you get about Greece as opposed to about the oil price or about China?
Well, there's a lot of questions about Europe. About Greece now,
what questions are they?
Well, there's still a lot of concern about the growth in Europe, and we think we're going to get negative growth this year in the Eurozone. There are concerns about the fact that there's disagreement amongst politicians. You know, Monti in Italy is saying we want growth, and Merkel is saying no, we must have discipline. We've got the whole French elections. There's a lot of concerns about Spain and the banking system, the fact that Spain keeps discovering unpaid credit card bills tucked behind its sofa cushions. It keeps adding to its debt. Concerns about Portugal and sustainability there. So there's still a lot of concerns. The sentiment about the Eurozone is generally negative. The view on Greece, by and large, is, well, they defaulted now. We've got a couple of years before they do it again. And so they've sort of pushed Greece to one side. The oil price is not coming up, I think, as a major concern at this stage. It's something people are keeping an eye on. But the levels that we're at the moment, you know, we've been here before. We were here last year. People are not too concerned about that. China, Asian growth in general, that's something we get a lot more discussion about. And obviously we're getting quite a lot of discussion about the US economy and the sustainability of US growth this year. That's an important focus.
You've already been to Shenzhen, or you're going to Shenzhen?
Shenzhen is next week.
Okay, so what are you going to, when you go there, what's the plan?
Well, I mean, I think the view that we take on the Chinese economy and how that's going to be developing is that we are seeing a shift, obviously, towards more domestic focused growth. We have to. Globalization in the accelerated form that we've had in the last few years isn't going to carry on. I think global trade is stable as a share of GDP. It's not going to be rising. In that case, we need more domestic demand, and I think for China, the focus is going to be more on social housing. That's really something which kicks in second, third quarter this year. Maybe some more investment spending as well. With a little bit of monetary policy easing, China will get 8.5% growth in our view this year. The fact that the official forecast is 7.5 gives me enormous confidence that we'll get 8.5.
They're always playing it down, aren't they?
Exactly. We'll beat the forecast.
Safely. Paul Donovan, many thanks for coming in again.
Thank you.
Have a great trip and, of course, safe travels.
Thank you.
Paul Donovan there from UBS.